Hello, this is Daniel Baranski, Vice President and Head of Research at Merger and Acquisition Services. Thank you for tuning in to the sample presentation on the initial PIC report on the medical malpractice sector. Our analysis shows that the sector remains an attractive market for expansion and/or acquisitions, primarily due to our belief that the sector should remain profitable over the next several years. The main drivers of that profitability include loss cost trends that remain tame. Over the past several years, there have been a plethora of state-level tort reforms, especially to non-economic and punitive damage caps on awards. This has dramatically improved frequency trends, and this trend should continue. In addition, cumulative rate increases since the onset of the hard market are substantial, in some instances north of 100%. This has resulted in much better rate adequacy. And lastly, we estimate that the industry could have in excess of $7 billion of favorable excess reserves. These should continue to filter through to earnings as more recent accident years develop favorably moving forward. That said, there do remain a few headwinds to the industry. One, pricing does remain soft. The most recent CIAB rate study indicated that rates were down 1% in the third quarter of 2011. The modest level of rate decreases should result in modest upticks to the loss ratio. That said, this should not counterbalance the impacts from the favorable reserve releases previously mentioned. In addition, there has been a lack of top-line growth and organic growth opportunities. Year over year, the top line was down 2% in 2010, and we would expect growth to remain challenged over the near term. Another trend impacting the industry is the continued consolidation, being driven by a lack of organic growth opportunities, low investment returns, under-leveraged balance sheet, and a desire to diversify the books of business. These trends should continue to drive consolidation for the immediate future. Investment opportunities within the industry include the aforementioned positive reserve position. The industry has been releasing about 7 to 8% of the total reserves annually for the past 4 years, and this should continue moving forward. This has been about $2 billion per year in reserve releases. In addition, valuations remain low, with price-to-book values about 1 times. This could facilitate further acquisition activity, as potential targets could be purchased at more attractive valuations than they otherwise could be during a hard market. On the alternative market, for owners of the managing companies or the attorney-in-fact, this presents an attractive source of fee income. This market has been thriving since the onset of the hard market, and there are now currently almost 140 risk retention groups or reciprocals. These reciprocals and risk retention groups allow access to the fee income and are a hedge against the migration of business away from traditional markets for the owners of these entities. The industry does also have risks. Again, pricing does remain soft, and this should result in modest upticks in loss ratios. There's also the chance for adverse development. While on an industry-wide scale, we would expect reserves to continue to develop favorably, on an individual company basis, we have seen more variability and some adverse development on an annual basis. There could also be a reversal in tort reform trends, either legislatively or judicially, and there have been a few states where tort reforms have been overturned in the judicial review process. For smaller companies in the industry, there is always the chance for large losses to significantly impact profitability, as their surplus levels and earned premium levels are smaller. In extreme circumstances, this can result in the difference between solvency and insolvency. The industry also has large-scale competitors, with 5 of the top carriers accounting for 31% of total premiums in 2010. These larger operations have greater diversification and at times can undercut pricing due to that diversification. Under these circumstances, a small carrier may find it difficult to compete and grow, and in some instances there could be cases of adverse selection against those smaller entities. With that, I conclude the presentation, and I thank you for tuning in, and we are available to discuss anything in this report in further detail.